8:13 here on Good Day. A Fox 35 consumer alert. More Americans are getting out of debt these days. That's good news, right? But others seem to think that stretching out those payments, especially for cars, is the way to go. This week, some top business magazines are reporting there's been an increase in the number of people who are getting these long-term car loans. We're talking 84 months. Quick math. That's 7 years. Joining us now on Good Day is Bert from Certified Financial Group. Joe, always good to see you. Thanks for coming in.
Morning, John.
Hey, okay, let's start with this one. We all know that you're upside down the moment you drive off.
Right. Who
does this work for? Who's this a good idea for, if anybody?
Well, it's perhaps a good idea for those folks who have tight cash flow, and unfortunately that's a lot of people today. But what you have to remember is that when you have a 7-year car loan, generally the interest rates are higher than you get on a 3-year or 5-year loan. And as you said, you're going to be upside down for a longer period of time in this loan. So if you trade cars regularly, it's really a bummer.
All right, I was in the finance business for a while. You know that. To me, this says people buying more car than they can afford. Do you agree or disagree on that?
Yeah,
if you got to stretch it out that long, there's something wrong.
Unfortunately, that's true. And what a lot of people say today, and you know you're upside down when your thinking goes this way, they don't really care how much it is. They just want to know what the monthly payment is. If you think about your finances that way, you are on the road to financial ruin. What you want to look at is what the cost is and how do I get it for the best cost, and then how do I pay for it. One of the things you may want to consider is getting pre-approved for the loan. Go to your credit union. Credit unions generally have the best interest rates on car loans. Or if you're in reasonably good shape with your job, consider a home equity loan, because the interest then is deductible. In the long run, that car will cost you less. Yeah,
let's talk about that too, because a lot of banks are now advertising these 40-year mortgages. People who we have on the show, like Dave Ramsey, say nothing more than a 15-year. What are your thoughts there? Is there an in-between here? Is it a good thing, bad thing to go 40 years?
Well, once again, it gets back to cash flow. I personally, for the long term, I get as much money as I can at today's low interest rates, long term. But if you're only going to live in that house for a few years, it's still not a bad idea, because think of it as rent and then you're going to move on. If you're going to ultimately live in that house, you may want to consider a shorter term period.
All right, good stuff. Bert, thanks, sir. Always good to see you.
You too.
All right.